Today I'm going to be introducing you to the Wiser Academy virtual classroom. First of all, a bit about myself. My name is Colin. I've been a trainer with Wiser Academy for nearly 7 years. And over my years with Wiser Academy, I've worked with some absolutely fantastic learners and felt proud to be part of their learning journey, whether face-to-face or through this virtual platform. The key information about these virtual classrooms, so as we've got here on the slide, we do aim to teach you around the certificate and the diploma level. Now, if you are doing a certificate level unit, there will be 10 sessions at each 2 hours a week, and that's for each unit you need to complete. And at diploma level, there'll be 18 sessions, 2 hours a week. And that's per unit you need to do for that one. Now, if there's at any point you can't attend a live session, the sessions are recorded and we can make that recording available so that you haven't missed out. And we also will give you access to an online site where you can do quizzes and mock exams designed to help you prepare for your final exams. So what I'm going to do for the rest of this session is kind of give you a sample of what a virtual session would look like. So as you can see from the slide here, we're going to look at what the sessions look like, how it runs, the facilities we use, and the ways we interact with the learner. So today's session, we will start to discuss the 6 principles of insurance, which you can see here on the screen. So we've got insurable interest, contribution, subrogation, utmost good faith, proximate cause, and indemnity. Now, going to launch a quick poll on the screen because I'd like to see, as a group, if you've heard of these before. So I've got a poll to measure that. So I'm just going to launch that and it should come up on your screen shortly. So you should see a question come up that says, how many of these insurance principles are you familiar with? So what would you answer, guys? Is it none of them, a few of them, most of them, or all of them? Okay, so we can see from that we've got the answer of a few of them. So nobody had gone for none of them, most of them or all of them, but you guys have come across a few of them, so that's really, really good. So what we're going to do is have a look into these in a little bit further depth and certainly teach you about maybe the ones you don't know about and grow your knowledge on the ones that you have heard of. So what we're going to look at in this session is we're going to look at insurable interest and we'll look at contribution, and then in future sessions we will move on to look at the others. So let's start with the first one we've got here, so insurable interest. Okay, so Chris, if I said to you, what is the definition of insurable interest? What would your answer be?
Is it to do with whether you want to insure something or not?
It definitely comes into play there. I mean, if you do want to insure something, this principle is a big, big part of that. Let me give you the definition and then we'll talk a little bit through it.
Okay.
Okay, so if we had to, because it's nice to have a definition, we can say, right, well, we know what this thing is when we define it. So insurable interest, we would define it as the legal right to insure arising out of a financial relationship recognized at law between the insured and the subject matter of the insurance. So I guess when we look at that definition, there's 3 key bits. I'd say we need to know what the subject matter is, legal relationship, and financial value. I think if we know what those 3 elements are, it should come together, that the definition makes sense. So let's start with subject matter, because I think that's probably one of the key bits. Now, when you hear the term subject matter in insurance, what I want you to think of, so we'd say the subject matter of insurance in a simplistic way is the thing you're insuring. Now, that might be a piece of property you own, it might be a liability you face, or it could be something in connection with your life. Now, for instance, I've put a picture of my kayak there on the screen because I love to do a bit of kayaking when possible, but I also do insure my kayak. So the subject matter of my kayak insurance, actually I could tick all 3 of those boxes, because there's the thing I'm insuring, the piece of property, which is the kayak itself. If I was to injure someone whilst out paddling, I do have an amount of liability cover that the policy provides. And then if I'm injured, the policy actually does pay out in the event of injury to my life. So when we talk about, the subject matter, that's what we're talking about. And a very simplistic way to think about it is the thing you're insuring. Now, you might sometimes hear them use the term subject matter of the contract, and that's more relating to the financial interest you have in something. So a bit like if you was insuring a property that has a mortgage on it, there's a financial interest in the mortgage itself, but also in the bricks and mortar. So that's the first one. Now, the second one. So, okay, Chris, here's another question for you. What would you say is the most recognized form of legal relationship between someone and a piece of property? Maybe like a house, for example.
When you have paid for it.
Okay, now certainly if we were talking about a house where we had a mortgage and we're paying for it on an ongoing basis, yeah, even though we're paying the bank, we would still say we own it. So I guess when we think of the most common form of legal relationship with property, we talk about ownership. Now, of course, for you to insure something, there's got to be a legal relationship. So could I insure your house in my name? Do you think?
No.
Because using that logic, I don't own your home. So I have no recognised legal relationship. Obviously, going to insure my home because I have a legal relationship with that. So I think it's understanding that, yes, we have the thing we're insuring, but we also need to have a legal relationship. And ownership's one of the most common. Now, there is other things. So, for instance, duty of care when we're looking after people's property, but certainly ownership's usually the most common one. And then the final bit that relates to those three for insurable interest is about its financial value. So, Chris, do you think you can insure something if it would be deemed as priceless or worthless?
There's no point in insuring it because we are insuring it against a financial loss. So I don't think so. It has to have a financial value for you to insure.
Yeah, absolutely. I mean, if it's worthless and it has no value, why would you buy a policy for it anyway? Now, if it was priceless and you can't put a price on what that thing's worth, how can the insurer measure what to pay you in the event of a loss? So there always needs to be a financial value you can put to the item. Now, even if it was something that some people would say is priceless, like your life, when you buy life assurance, you do put a value on your life, as in the amount of money you'd want to be left to your loved ones or to your estate when you passed away. Well, although life is priceless, by you putting a price on it, then you can insure it. And then, of course, the insurer will have a measure of what they can pay you. So I think when we think of that principle as a starting point with insurable interest, as long as we understand those three key areas, that there's always going to be a subject matter, so the thing you're insuring, there's always going to need to be a legal relationship for you to insure it, and that thing needs to have a value that can be measured by the insurer so that they can pay you. So that's sort of an introduction to insurable interest as a concept. So what we can now say is, so far we have discussed, well, we've done insurable interest, so I can tick that off our list. And we can see that the next one on the list is contribution. Contribution is a principle found in insurance that relates to the situation where an item is insured in full with multiple insurers. So just as an example, let's say, okay, I've got a camera and my camera could be covered in full under the personal belongings of my home insurance. I might have some form of gadget insurance that also covers my camera as well as my other gadgets. So in essence, I've got the subject matter, the item, potentially insured in full in two places. So it's a concept we call dual insurance. Now, if my camera was to be stolen and I was to claim on my personal belongings section of my home insurance, one of the questions they do ask is, do you have that item insured anywhere else? And if I say yes, then what they would look to do is gather details of that other insurer. And the reason for this is so that they can write to them and ask them to share in the loss. Because if you've paid two premiums to cover the same thing, then it's fair that both of those insurers should share the burden of that loss amongst them. And what we would refer to that, as we can see on that sort of the third bullet point on the slide there, is we would class that as the insurer's rateable proportion, so their share of the claim. So I think as long as we understand contribution is about the sharing of a claim between multiple insurers who are responsible for it, we have the core understanding of the principle. But of course, now there's going to have to be some maths, because if we're going to need to work out each insurer's share, there's going to be a calculation to work that out. We can see there that I've got two sums for you. I've got the sum that's called by sums insured at the top. And in my experience, this is the sum you would often see used to work out each insurer's share of the claim when the customer is correctly insured. So there's no underinsurance situation. And the sum down the bottom that they call by independent liability, in my experience, has been more commonly used when there is still many insurers, but the customer is underinsured. So we have these two separate sums. Okay, so here's a question where we're going to look at using the by sums insured sum. So Amanda's house is valued at £200,000 and is covered by two fire insurance policies, one with the sums insured of 100,000 and the other with the sums insured of 200,000. So in this scenario, Amanda's got a house at 200,000 and in total she's got £300,000 worth of insurance. So do you think her claim will be getting paid in full, Chris, based on those figures? Yeah, because she's definitely got more than the £200,000 insured. But what we're going to try and work out is how much the first insurer, the one with the sums insured of £100,000, would contribute towards the loss. So the rest of the question says, under the principle of contribution, what maximum payment will the first policy contribute if a fire causes damage costing £60,000 to repair? Okay, so in essence, we're going to have to do a little calculation. So if I just draw over here on the right, we'd have a line with a little multiplication symbol, and we're going to need to have three figures, one at the top, a second at the bottom, and a third at the end. Now the one at the top would be our sums insured for the insurer we're looking to work out. The figure at the bottom is called the total sums insured. So that's all their insurances added together. And then the one that goes after the multiplication is the loss. Now, have you got a calculator at all with you, Chris? I was going to get you to have a go at it before revealing it.
Sure, yes. Okay, I've got my calculator. So first is sum insured.
Absolutely, and we're looking for the first sums insured. So we know in this scenario
is 100,000.
Absolutely.
And then we're divided by total sum insured.
Excellent.
Which is 300,000.
Correct, because that's our two policies added together.
And then multiplied by loss, which is 60,000.
Absolutely.
So 20,000 is the answer.
Now, so if you can imagine this as a question in your exam, you've just worked it out, you've come to the 20,000, and it's always good when you see the 20,000 there as one of the options. And I can reveal,
yes,
that is absolutely spot on. So I think
Excellent.
even though you hadn't come across it, we can follow that concept of, well, we need to work out a share of how much that insurer will pay for the claim. And the question will always give us the figures. I think the key bit for me is knowing where to put those figures. And I think that's where those sums are very, very handy.
Yes.
So that's basically how we would work out contribution. So that kind of gives us that mindset of how to work it out. Now, did you want to have a go? So in this scenario, we've got an underinsurance situation, so we're going to be using the other sum. So Colin's kayak is valued at £2,500 and is insured under two separate policies. Policy A has a sum insured of £1,200 and policy B has a sums insured of £1,000. So unfortunately, we can see here that we've got some goods that are valued at £2,500, but only £2,200 worth of insurance. So without looking any further, is Colin's claim going to get paid in full?
No.
And absolutely correct, because when you're underinsured, that's the risk you're taking by underinsuring, is that your full claim will not get paid. So the question now says, under the principle of contribution, what payment will policy A contribute if the kayak suffers £500 worth of damage? So again, just to the right here, I'll draw our little equation.
Okay.
So what figure, I'll write it on the screen this time, what figure would you say we need to put at the top of this sum? So our sum's insured for this scenario.
So the sum insured of policy A,
Yep.
which is 1,200.
Okay. Now, when we looked at this sum a couple of pages ago, we now use a slightly different figure on the bottom, and it's actually the value.
Which is 2,500 pounds.
Excellent, excellent. And then the value of the loss would be
£500.
Excellent. So I know that's almost like a maths 101 step by step, but I think once you're comfortable with it, these are the things it makes it a little easier when you get to your exam. So with your calculator, how much is policy A going to contribute towards the £500 loss?
£240, option B.
Okay. And if I reveal, excellent. And something that I sometimes find helps some of our learners is when you look at that sum, you can say that 1,200 is nearly half of 2,500. So you already know that the answer is going to be somewhere around half of the 500. So sometimes you can sense check it as well as doing the calculation.
Okay.
Okay, so that was us working our way through contribution. And you've now seen sort of what contribution's about and how we would work out the rateable proportion. So what it's time for now is a quick quiz to see how we learn what we've gone through. So I'm just going to bring up a test on the screen for you to complete. So I'm just going to launch that now. So what you should see come up on your screen is a short quiz with 4 questions. They are multiple choice questions, very much like we would see in our quizzes, our mocks and our exams. And there is only one right answer. So I'd like you to have a go at those questions. And once you're finished, if you hit submit, that will then come up on my screen. So I can see that those tests have all been submitted now. Okay, so let's just review. Okay, so we can see that there's an average of 50% scored correctly. So when we look at the breakdown here, question 1 was incorrect. So when we look at this question, John has a fire insurance policy fully covering a building. Now the building is destroyed by an insured peril 2 weeks after John has sold it to Luke. What will John receive from his fire insurer? Now, when we look at the answer of A being nothing, in this scenario, as John has sold the property to Luke, John no longer has an insurable interest. So in that sense, it would be like me trying to claim for my house being destroyed 2 weeks after I've sold it to you. Well, being that it's no longer my house, I have no insurable interest and no right to indemnity because it's no longer my property and I haven't made a financial loss. I suppose in that scenario, you would have gained because you'd have sold the house and you would have claimed some money. And that's certainly not what insurance is about. Does that make sense on that logic?
You get paid. Yes, it makes sense now.
Absolutely. Excellent. With question 2, so this was one of those contribution ones. So Colin has £75,000 worth of goods stored in his warehouse, which is insured under 2 separate policies. So we've got policy A, which has a sum insured of 75,000, and policy B, which has a sums insured of 115,000. So
Yes.
there's definitely the right, well, I suppose you could argue there's definitely the enough insurance. Almost you'd say there's over insurance.
Yes.
So he's definitely going to get his claim paid. So in this scenario, the question then goes on to say, there's a fire causing a loss of £45,000. How much would policy A contribute towards the claim in this situation?
Right.
So we're looking for the situation of, right, we just need to know policy A. So thinking again of our sum, where we have the figure at the top, the figure at the bottom, and then the figure at the end, which is the loss. So we've got the £75,000, which is at the top. That's our sums insured for policy A.
Yep.
We're then dividing that by 190,000 because that's your policy A and your policy B added together. And actually, that's one of the what figure did you put at the bottom to work it out?
I put the sum insured, no, the value of the goods, 75,000.
Right, okay, that makes sense. And I guess in that scenario, because they've got the right amount of insurance, the figure we put at the bottom is the total sum insured. So you end up with a sum of 75,000 divided by 190 and then multiplied by 45.
Yes, makes sense.
So fantastic. So that was a sort of quick introduction to the 6 principles of insurable interest, and we will continue the others in our next session. And that's how the sessions would basically run.